And welcome back. Joining me now is Kristina Huber, a U.S. investment strategist from Allianz Global Investors. Kristina, thanks for joining us.
Thanks for having me.
So we are facing potentially a rising interest rate environment. We don't know what that's going to be. Obviously, this is something that, in collaboration with your colleagues here at Allianz, you're having active discussions about how to plan for this potential rising interest rates. What kind of conversations are you having about how to prepare?
Well, first and foremost, we're saying it's likely to happen sooner rather than later. If you look at Fed funds futures, the market has very different expectations than what we think the Fed will do and when it will start liftoff. So first off, don't be caught unaware. Recognize that it could happen sooner rather than later. But second, and far more important, is that liftoff is not nearly as important as the path of rates. We think the path is going to be very different from the last 4 Fed rate hikes. So we can't look at that playbook as an example. We really believe the Fed when they say they're going to be data dependent. And so at every juncture, they're really going to analyze the economy. So our expectation is liftoff happens sooner rather than later, but we could easily see a pause for a while as the Fed watches the markets and the economy digest an initial rate hike. And then it may take some time before the Fed moves again. Our expectation is that at the end of the day, it's going to be a very low, slow climb higher, and we could finish at a lower, what is considered a neutral rate, than what is typical for a rate hike cycle.
Thank you so much, Kristina. You know, many of our clients, I think our combined clients, are defined contribution clients where participants are actually investing money. And they oftentimes are lagging in terms of what's going on. But really, many of them are investing in target date funds, what are becoming a very popular form of investment in a lot of these plans. I know we just had on Glenn Dial, who really is responsible for developing these types of products. You all work in concert with one another to kind of figure out where the market's going to go and how to build a product around that. Can you talk a little bit about that collaboration, about developing products?
Sure, absolutely. Very much products are designed for clients. And so target date couldn't be better thought out in that what we're recognizing is that clients often act viscerally. They often act after the rest of the crowd acts in 401ks. Sometimes they don't have every opportunity to do that right away. They usually wait until they get their statement. So we recognize that, and that's why target dates are such an important component of investors' 401k portfolios, their retirement portfolios, because it enables them to have exposure to a broad set of asset classes and have it actively managed so that there's movement as they progress and get closer to retirement. That is critical, and I think that as time moves forward, we're going to realize more and more target dates and other actively managed multi-asset class products are sometimes the best solutions for virtually any investor because it enables them to embrace opportunities, deflect risks as much as they possibly can, or at least manage those risks. And so it's a great solution. And if you think about today and where we are, there's a lot of uncertainty in the market. I would argue that today there's actually the potential for much higher volatility for bonds than there is for stocks, even though many investors may not be thinking that way. Many clients may not be thinking that way. And in fact, some may have, if they're allocating their own portfolios, their own retirement accounts, they may have an overexposure to bonds. Target dates will give them an appropriate exposure to stocks and bonds. It will enable them to pivot, to turn, and that's really what this is all about. We expect more volatility, not less, and we expect active management will finally make a difference. You know, the last 6 years has been about quantitative easing, this incredibly extraordinary monetary policy environment, changing the rules. It's a rising tide that has floated all boats, and active managers have had a lot of difficulty distinguishing themselves because we've had such a high level of paired correlations. Well, that's out the window now. We're seeing correlations go down among stocks. Stocks are going to rise and fall not based on QE but on fundamentals. Asset classes are going to rise and fall based on fundamentals, and in that kind of environment, active managers make a big difference. So that combination of having a target date, having life cycles in mind, but also just having that exposure to many, many asset classes is what's going to help investors weather what we expect to be more volatility, not less, in the future.
And you talk about volatility in the fixed income market. That's something that we really haven't seen in the last 20 to 30 years. Participants maybe erroneously, if that's the right word, believe that you can't lose in the bond market. They could be in for a comeuppance, so to speak. One, outside of individual bond funds, one area that uses a lot of fixed income is stable value or fixed annuity products, and that's an area that plan sponsors, employers really need to be getting under the hood and thinking about these products more closely. In many of the plans that we work on, and we work on both 401k and 403b plans, a lot of 403b, 40 to 50% of the plan assets are invested heavily in these stable value or fixed annuity products. So I think it begs the question, let's get under the hood, let's figure out what is in these instruments and try to set and reset both the employer expectations and the participant expectations about how they're going to perform.
Absolutely. Investors need to be incredibly vigilant right now. Clients have to understand that the bond bull market is coming to an end. What Paul Volcker set off in the early 1980s is ending. Now, it might not happen all in one fell swoop. As I mentioned, we expect a slow, low increase in rates, but it's going to be a reversal of something we've seen that has occurred over more than 30 years. And it's not going to be easy. And I'll give you a perfect example. We got an insight into what it could look like back in the spring of 2013. Chair Bernanke at the time talked about how QE would be ending soon, or the potential for tapering to begin. And that set off an awful lot of trauma in the bond market. Certainly stocks sold off, but we saw much more of a sell-off in bonds. And in fact, a 30-year treasury, had you put $100,000 in April of 2013, would have gone down in value to $83,000 by just July. So in a 3-month span, a huge loss in value. And that gave us a taste of what could happen and what could really catch clients off guard who have significant exposure to core bonds.
And that, we've been talking with Dr. Bernarzi, Dr. Guerzi about behavioral finance and incorporating that into a strategy for education and communication. Retirement, at least on the defined contribution side, is really a shared responsibility, the employer and the employee working together. But the employer really needs to create a customized communication strategy and talk about these, what can often be very complex terms, in a way that is meaningful to participants. I think in our industry, we all tend to use a lot of the jargon, and it's very complex, and what we do is very complex, but taking it and simplifying it for individuals is important, especially as it relates to defined contribution plans.
That is the great challenge and the great opportunity of being a fiduciary. There is an enormous amount of responsibility, but with it comes the potential for enlightenment and helping clients really understand just how different this investing environment is. And that's really been a challenge since the Fed embarked on quantitative easing, because it really has changed risk and reward profiles for different asset classes. And many investors, many clients did not understand that or recognize that. So to educate them about that and educate them that this is an ongoing issue, that we continue to see shifts in risk and reward among asset classes, is critical. To understand that monetary policy environment enables investors, clients, to understand far more fully what the implications are for different asset classes. And that's critical right now. We're at a very important juncture, and they need to have that communicated to them in ways that they can understand so that they can be better equipped to meet their goals.
And the key word, I think, and you made a lot of really good points, but the key word I took away is ongoing. As a fiduciary, you have an ongoing responsibility to review and evaluate your plan and to communicate to participants and employees in the group so that they understand what's happening, and incorporating those aspects of behavioral finance to make sure that people are doing the right thing. So it doesn't just stop with the selection of the investment option or what's going on today in the market. It means coming together on a quarterly basis, semi-annual, whatever the frequency, at least once a year, to come together to review the plan, but also to discuss, hey, what's going on in the plan? What is the data pointing to? Where are people investing? And where can we target people appropriately? And that's got to be something that you think about in your discussions with clients as well.
Absolutely.
Sure. Great. Kristina Hooper, thank you so much for joining us today.
Thank you for having me.
And thank you so much for joining us.